Hey, this is John from Gadeon. Today I'm going to discuss the use of DCF models and developing some intuitions about them to apply them in your analyses. So we'll also show an example from a report prepared on Capcom. It's not an official report and it should not be taken as investment advice. So please don't view it in that way. Okay, so purely for illustration purposes. Now, so we're gonna just go through this on a tablet first, just because I do want to spend some time talking about the intuitions behind the modeling. And that's probably more important than really discussing like specific use cases, to be honest. So let's start there. Now, so we're going to discuss the DCF models overall, the free cash flow to equity, coming up with appropriate R's or your discount rate, and then we'll go through an example of Capcom, as I had mentioned. So first, DCF stands for discounted cash flow. So this should tell you most what you really need to know about it. We take the cash flows and we discount them to present value. Now we're going to talk about what that really means in a minute, but let's show a very general model. So we are going to take the sum of our cash flows at each interval or time and divide them by 1 plus our discount rate to the exponent of the same time interval. Now, if this is beginning of the year, then we'd start with I equals 0. That way we don't discount the cash flow today because we discount the cash flows from the future to the present. So if this is at the end of the year or end of the period, whatever, because this could be months, for example, we're going to start I off at 1, and then we'll say it goes to N or big N, whatever you want to use. The notation here doesn't really matter. These are all arbitrary variables. So that's our basic model. We take the sum of the cash flows and we divide it by, or each of those cash flows by 1 plus our discount rate. Now, what that expands to is, for example, our first cash flow divided by 1 plus. And there's probably a lot of people that are familiar with the summation notation already, but this is essentially what it breaks down to, right? Now, there is one other way that we can maybe think about the summation operator. And, this way of thinking of it is useful for programming and for developing more intuition about the properties inherited by the summation operator. So we'll talk about this briefly. We can also view the summation operator as a matrix, let's just say in some field of n by n dimensions. And this is basically a diagonalized matrix with some scalar quantities on the principal diagonal. If you don't know what that means, basically what that means is that we have, some m rows, n columns, and then we have along the principal diagonal something like, let's just say I for an identity element, and this would be mn blah 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 I mn, this should be 0 0, but anyways, like so. And then all of this empty space just means that all the other elements are 0. So this is another way to think of the summation operator. Now, if you don't know that, that's fine. It's not really going to be super important for the rest of this. It's just another way to develop intuitions. And it also tells you a bit more about how this behaves, because we can take the summation operator now and multiply it by a vector of our, transpose vector in this case, of our cash flows, like so, and get the same sort of sum arrangement, right? Like that. And then if we make our elements of this diagonal into, for example, 1 over 1 plus R to either the row or the column indexing. So, let's just say row, for example. Doesn't matter because it's a symmetric matrix here. Then we'll get the same, literally the same formula. So it's blah, blah, blah. That's just another way of viewing it. You probably haven't, you may or may not have seen this before. Okay, so now let's talk about the cash flows. So what do we actually put into the cash flows? Why do we use cash flows? So the primary use of the DCF model is to develop an equity valuation. Now, when you purchase equity of a company, you are thinking, okay, I have placed some value on the ownership of this business, so I'm going to buy a certain percent of the business. So you are buying, in effect, a percentage of the earnings, or at least, if that's supposed to be what you're buying, some percentage of the earnings, basically, above a certain percent. And maybe one thing to note, too, about equity holdings is that you effectively have second lien on those payments compared to, say, debt holders. So debt holders, or people that purchase bond, when you buy bonds, you are selling debt effectively, if that makes sense. Or the company is borrowing money from you, and then they have to pay that back, or at least in the event of bankruptcy, for example, they will try their best to. So yeah. Now, so that should make it a little bit more obvious why we're using cash flows here, because cash flows are obviously an indicator of profit for a company. Now, why cash flows to equity in particular? Well, cash flows to equity are going to be the amount of cash that is available to equity shareholders. So basically what free cash flow to equity is, and this is just one formula, there's a lot of other formulas and we'll go through that later, but I just want to maybe go through one or two main ones to develop some intuitions. But you can learn the rest of the formula, I suppose, somewhere else. So we are basically going to be taking the cash flows from operations, or our cash flows from this year. We're going to take off our CapEx, where CapEx in this case is a proxy for fixed capital investments, which basically means any long-term investments that we make. So CapEx is short for capital expenditures, and it's kind of the opposite, let's call it the complement of the working capital investments that you'd make. So working capital is going to be the things that you invest in for the benefit of this year, and then fixed capital investment are long-term investments. Okay, and then we're going to add our net borrowings as well. So what net borrowings are, basically, how much do we pay back the debt holders, or like how much debt was retired versus how much do we take on. So it turns out, and this kind of makes sense when you think about it, that we can take on more debt to have more cash available to the company to then pay shareholders. So you can see there's obviously a bit of a conflict there between the two types of investment. But this is kind of the idea, right? We are taking all of the cash available to the company. We're going to, as we'll see in a minute, take out any cash that's going to the debt holders, and then we're going to take off any expenses that we're not going to recover this year. So we'll go through a couple other equations. So another way to describe free cash flow to equity from a more, say like primitive stance is going to be that we take our net income. Yeah, that's self-explanatory. And we're going to add our depreciation and our amortization, which are slightly different. Amortization is basically depreciation for intangible assets. We take off our CapEx, which we discussed earlier. we take off the change in our working capital. So as I had mentioned, working capital in this case is going to be referring to, the change in working capital refers to how much did we spend for the benefit of this year. So you might be kind of confused about what kinds of things we would actually spend, like, what would include in CapEx versus what we include in working capital. Well, I think a very obvious example of capital expenditures could be something like a building, right? Whereas something like working capital could be, like a technology subscription for, the year. So those are just some examples. And we'll see like lots of ways because, when you're looking at this stuff, these broad categorizations, it's very important to understand what they really mean, because when you go and look at the actual model, it's very, very different from what you're going to see from these like groupings of the concepts. And then, like always, we add our, we're just going to summarize this with NB, net borrowings. Okay. So again, the idea is we take cash from this year, we take off any expenses that we're, giving out this year. You might be kind of wondering, well, why do we add back depreciation and amortization here? The reason for that is because we take the depreciation and amortization off of the net income, but that wasn't actually cash spent this year. That was technically cash maybe we spent on another thing, like say, computers, right? That we now write off this year, but we, did that earlier. So that's why we add that back. Okay. Now let's also work from free cash flow to the firm, just so we can kind of see the difference. And again, free cash flow to the firm is useful for things like enterprise value calculations, but we don't really do a lot of these. Okay, so what is free cash flow to the firm? Well, it's pretty similar to free cash flow to equity, but like you're going to see, we're basically, so for example, if we look at the formula, at the start of the formula, we have cash flows from operations or operating cash flows, and we take off our CapEx like we did up here with the free cash flow to the flow to equity, but we're going to add back our interest expense times 1 minus our tax rate. Now this has to do with the fact that debt payments or interest expenses are tax deductible. So that's why that's here. And then why do we add back our interest expense? Well, because we're still including all of the cash that's still available prior to paying the debt holders, that's still available to the debt holders and the equity shareholders. So that's why we add this back here, and also why we don't, consider net borrowings for, obvious reasons in this case. Okay, so working from the free cash flow to equity, how do we get to, from the free cash flow of the firm, how do we get to free cash flow to equity? So basically, if we say, okay, free cash flow to equity equals free cash flow to the firm, and we are going to obviously want to take off our interest expense times our tax rate, and then we are going to add net borrowing. And as you can see, this follows directly from the differences in the formulas, right? Free cash flow to equity is basically free cash flow to the firm without the interest expense, but adding the net borrowings. So hopefully these are the most illustrative examples of the equations that you can use for your free cash flow to equity calculations. Okay, now let's discuss calculating the discount rate. So, and then we'll also talk about some more generalized models for the DCF models as well. But yeah, okay. So let's start off with the discount rating. Okay, so first, it's worth understanding that, if we think about the concept of present value for a minute, why do we discount to the present? We discount to the present because there is an opportunity cost to investing your money in something versus something else. So we want to know what that cost is, or how much do we value the cash today to make an investment in the future, for example. So that's kind of the idea behind how we calculate this discount rate. is to say, how much would we expect to earn given the risk that we are taking from this investment? So with that in mind, there are some different ways to calculate the discount rate, but as, for example, Damo Darren has commented, the most reliable model is the CAPM, or the capital asset pricing model. So the capital asset pricing model basically says that we have an expected return equal to the risk-free rate, and this is usually taken from things like bonds, like treasury bonds. So we're looking at the return on a risk-free investment. So that's our risk-free rate. And we're going to add beta, and we'll talk about what this is, times our equity risk premium, where our equity risk premium equals the return, like expected return on the market over our risk-free return. So the reason why we use the market return here, and the market return is typically going to be proxied by something like the S&P 500's returns, for example, though you do want to pick a suitable benchmark. And more than that, whatever you pick the market returns to be, that's what you want to base your beta value on. So what's beta? Beta is basically the scaling factor compared to the market returns. So the way that you calculate this is basically it's the result of regression on those returns. So for example, let's take a, we're not going to take a peek at the Capcom model, but let's say we wanted to figure out what kind of beta we would want for the for Capcom. We would take the historical returns for Capcom, and we would regress them on, say, the S&P 500. Now, there might be a better index in Japan to use, for example, for Capcom, or there might be other things like, I don't know, maybe like an industry, because we might want to use like something like an industry benchmark instead for this, right? So, for example, Capcom works in video game entertainment. Are there indexes that reflect video game entertainment that we might regress better on the S&P 500 in this case? And the reason why we might be interested in doing this is because really the biggest factor affecting companies, or like the single biggest factor, let's say, affecting company success happens to be the industry that they're in, or their industry characteristics, rather than an individual factor of the company. Though that's not to say that those individual companies can't have breakthrough successes or serious failures that are isolated. That's just a general fact about the way that companies function. So, okay. Now, so again, basically we're just adding our equity risk premium times a scaling factor and the risk-free rate. Straightforward. Now, there's also an expanded CAPM that we can use. So, just to talk about one of the other models, to give some idea of how do we actually incorporate risk into a model. Well, so let's take the expanded CAPM for a second. What does that say? We'll basically take our expected returns from the CAPM model, and we're going to, so our new expected returns, by the way. Okay, let me just rewrite this. Expected returns equal our expected returns from the CAPM model. So again, you can see up here what that is. And we add other premiums. So for example, we can add a size premium, an industry premium, and a company premium, or a specific company premium, if you will. So basically to account for other factors, like is the company large or small cap? So if the company's small cap, and again, think about it from the risk return perspective, right? We want to earn higher returns from a small cap company compared to a large cap company to make the same investment. because we are taking more risk on. Similar thing with a specific company. We might have certain issues with a company. We might have issues with an industry. So we want to add those things potentially. You don't have to. From my understanding, these don't really add much practical value. So, and maybe one thing to kind of mention as well with general modeling is that we do want to try to use multiple models to calculate the same factor, because each of these models has their own quirks and their limitations. And so the idea is that by using multiple models, we can kind of cover up some of those weaknesses. Forget where I was going with the rest of that. Oh, yes. If we take a lot of assumptions, though, on the other hand, then we really kind of open ourselves up to being more wrong, because when we're forecasting things, we have to base them on assumptions, and those assumptions are exactly what they sound like. So really, preferably, we have as few assumptions as possible, or at least as is reasonable, because as we have to make more and more assumptions, our future projections are more contingent on what we think about the markets today. So it might seem like we're getting greater control, but we're actually not. We're losing it after a certain point. So that's something to keep in mind. We don't really want to incorporate a lot of assumptions into the model, and it's hard to know exactly how many assumptions we should use, but yeah, just keep that in mind. There's no hard rule for how many assumptions, though, but less can be more. Okay, so what else do I need to go over here? Okay, yeah, let's go over some of the other more like general models, right? So once we kind of understand how that works, really the other models are basically saying, at different points in time, those assumptions can change, right? So for example, what kinds of assumptions might you have about the cash flows? Well, you might make an assumption that is related to the revenue growth rate. And let's say a company is a small size company, right? Well, or small cap company, small cap company. Well, over time, this company is going to become a large cap, potentially. And their revenue is going to grow a lot faster as a small cap than as a large cap. So, for example, revenue growth might look like this. Now, not that it necessarily will, but the idea is that as a company gets larger, it becomes harder and harder to capture more relative market share. So we might want to divide these assumptions up. Additionally, usually the kinds of projections we're making for the cash flows are on a finite series. So, we noted up here that the cash flows run to n. These are not, as n approaches infinity. Like, this is not true. But we do know that the company is assumed to be a going concern. So the actual modeling ought to reflect that a company may exist indefinitely. So how do we deal with that? Well, basically we do two things. So the first is that, for, let's say we have changing assumptions, well, we simply take our, DCF model and we split it up into different regimes. So for example, we might have cash flows at this, section, right? Let's start off and we go up to, let's even simplify this and say N1, okay? So the end of our first time period. Now, in the second case, though, we are then going to have a second set of cash flows, let's say, with a new growth rate. And let's just put it like this. We're just going to generalize it for now. There are, better ways maybe or more comprehensive ways to write these models, but we'll just, put it like this, right? We have some second set of cash flows. Let's say, it starts off at P, so in the future, right? and then P starts off at N1 and they go up to N2, and then we have, so like that. And that's kind of the idea, right? We can split up these cash flows into different segments, and then at the end, we add what's called a terminal value, where our terminal value is usually an estimate of, for example, we, maybe take our cash flows at the end. So let's say at N2, and we might want to take this and multiply it by 1 plus the growth rate, whatever that is at the terminal value to get the next period, and then we're going to divide it by our discount rate. Yeah, that's pretty much how that works. Now, if I'm not mistaken, I think I'm supposed to be taking off the taking off the growth rate as well. So whatever. Okay. So yeah, we also subtract the growth rate, which does suggest as well that, so for example, one of the ways that this might not make any sense is if we have the discount rate below G, or below our growth rate. So like this basically just can't be true. If this is true, then we're going to get a negative value for this, which means we'd have a negative terminal value. Alternatively, like let's say our G approaches R, so they're very, very similar. Well, now this value might break down into nonsense, because we might get something that's, because as G approaches R, the value of G, or let's say like let's just write this out like so. The limit of G is going to, or of R minus G is going to be 0, right? Which means that, as an alternative, right, this would imply that the terminal value approaches infinity, which is obviously nonsense. So, we really have to think about these things from that perspective, and to make sure that our growth rates and our discount rates make sense when we model them. Okay. So, I think that's pretty much what I want to say about that part. Now, let's turn off the recording, and I'm going to, or this set of recordings, and we'll go and look at the model here. So we're going to spend too much time on this, and again, this isn't an official, equity research report, but we're just going to kind of flip through. I mean, it kind of looks like it, but it's really just like model, right? So anyways, you can see some of the other things. We're not going to talk about this here, but this is like kind of what a research report might look like when you're running the modeling yourself. You separate the inputs and the assumptions. You have some scenarios that you want to calculate. And this, by the way, is very much very similar to the way that Ian Schnorr teaches this in the CFA Level 1 financial modeling module, in case you're wondering. That's kind of the stuff that you learn to do. Okay, now let's talk about the model. So we're not going to go through a lesson on financial statement analysis today, but let's kind of flip over to where you're likely going to have the most trouble, which is here. So you can see here that this is our net cash provided by our operating activities. We have projected cash flows up to 2035, as we can see. And by the way, just to highlight different cells across that are disconnected, we hold control. And how are these things calculated? Well, if we go and look at the formulae, right, we can see that, okay, we just add these, right? And what about the subtotals here? Well, you see that there's formulas here. We're basically just adding all of these items. The reason why these are separated, by the way, is kind of funny. But basically what you'll notice is that if you have to make changes sometimes, or if you do like what I do here, which is add percentage values, I don't really want to say just sum over the entire like column of cells, because then it'll start to incorporate these values as well. So that's why we have it like this, and also because I might copy and paste certain values and move them around and such. So that's It's kind of an unfortunate thing, I suppose. But once you have it for the first cell, you can just copy the rest down because they're the same, right? Now, so that's pretty much what that is. And you can see here too, just so that you're aware, like the cash flows from operating activities. And this is why you really need to understand those principles, because there's so much that comes up in companies that if you don't understand what is actually included in working capital, what's included in fixed capital investments, it's going to be extremely difficult to categorize these and generate your operating cash flows. Now, one thing to mention too is you also see here that with the economic scenarios, so I did basically use what's called the H model for which is the generalized CAPM to split up regimes, to say, okay, basically have differing growth rates after a certain point, and then it eventually levels out. Yeah, so that's how that looks, and then all these are just linked back to assumptions. Anyways, we're not going to go through too much of that, but as we go down, we will get our free cash flow to equity down here, and then we calculate the present value of the free cash flows to equity, and we kind of have to do it like this, unfortunately, like individually rather than as a single formula with the one cell. And then here I just put the growth rates, and you'll see that these are just linked. These are just calculations just to see if this makes sense when I'm looking at it, because it's very easy to create assumptions that maybe make sense today, but then in 10 years, if it's still like let's say a 20% growth rate 10 years from today, well, with a company this size, that's probably not reasonable. So, and really even 9% is pretty high. I don't know what case this is right now, but yeah. And then there's some other stuff here that you can take a look at. Now, what do we actually do with this free cash flow, these free cash flow values? Once we have the present value of the free cash flow calculated, again, this is linked over to our assumption sheet. So if we go over to the assumptions, and we take off a little bit of this, but let's just go over to the assumptions sheet just to, we have our cost of equity. So cost of equity in this case is, what we're saying is the discount rate. So, and the reason why we word it as cost of equity here is because, again, there's an opportunity cost for not investing in something else. So that's the cost. Now the beta here, you can also obtain these from industry reports. You don't necessarily have to get them yourself, but you should know where these values are coming from, especially in a natural report. And again, this isn't a recommendation, so don't take it like that. So some of these things, did I really bother to check beta? Maybe. I don't even remember, to be honest. But yeah, that's one of the reasons why you would not want to consider this an investment recommendation. Now, there's definitely some interesting things to say about the valuation stuff that I did here. Fortunately, we're not going to talk about it. Maybe I'll talk about one interesting thing that I looked at, which was the, because it was kind of unclear if, when I was looking through this, does Capcom actually perform as well relative to its peers in a sensible way? Because, sometimes we see that, investors might irrationally pump up a stock, right? So we want to ask, okay, does this make sense? One of the ways that I tried to do that is with, number of IP or intellectual properties that have sales exceeding 20 million. And so you see I did that across the peer companies. Anyways, just, one idea for different things that you can kind of look at to, also consider. The credit analysis that I did on Capcom also was perhaps in some ways very instructive as well. So, maybe someday we can go through that. Now, we can see here that if we go to the present value of the cash flows model, or the discounted cash flows model, we take our sum of the present value of the free cash flow to equity, and then we have our terminal value. You can see that our terminal value is based on, let's just go and find this cell, but it should just be, so AC 156, it should just be AC 156. Yeah, right here. So this is our terminal value, and then presumably we multiply this by 1 plus the growth rate that was assumed, and then our discount rate minus our growth rate, right? but those are linked to the assumptions. I'm probably not going to flip back there. Okay. And then we use that. We calculate the present value of our terminal value, and then we take the sum of these two as, whoops, wrong F key. So if you press F2, by the way, you'll get to see the formulae, or like the cell linkages, because it'll enter the cell. Likewise, if you press F2, well, maybe the difference, right? Like, let's kind of go over this. If I press F2 the first time, you see I navigate within the cell. If I press F2 a second time, you see I navigate outside of the cell. So, yeah, but anyways, you see that we add the sum of the present value of the free cash flows to equity and add the present value of the terminal value. Okay, and then we take our, we divided this by the number of shares outstanding. And then this is some scaling factor. I can't remember why. Well, this will be clear when we go and look at it. So this is the fully diluted shares. I think somewhere in here I probably just, because I think the values in the statements are like scaled down by a factor of 1 million, presumably. So that's probably what this is doing here, just to, you know, rescale it back up. So anyways, that's kind of the expected value per share, at least at the time that I did this reporting. But again, this isn't a professional model. It might look professional, but it's not a professional model. No. So yeah, don't use that as a investment recommendation. Okay, so that's kind of how that looks in an actual model. So hopefully that was useful, and hopefully the explanations for discounted cash flow models was clear and useful. Okay, if you liked the video, please like, subscribe, and share it. Otherwise, take care. Bye.